Welcome everybody, this is Raghee Horner, and thanks as always for joining me for our Thursday night IBFX live webinars. Tonight's topic is going to be handling market transitions, as you can see there from our opening slide. And again, I'm Raghee Horner, IBFX Chief Currency Analyst, and I'm going to be sharing with you tonight the views that I have on the market right now, some of the things that I'm seeing on the pairs that I analyze and trade. Of course, if there are questions that you have about our topic, if you have questions about a particular pair or time frame, let me know and we'll work that into our discussion. Of course, we always use live charts, we always use current examples, so we'll be spending a lot of time on the IBFX4 platform, looking at charts and the tools that I use. On top of that, we'll be using my, I'm not a big, you guys know if you've ever seen me present and if you've been to any one of these talks, you know that I'm not a big fan of PowerPoint necessarily. What I like to do is just kind of take notes as we're doing our discussion right on Word document, and we'll be using that for some note taking, and if there's particular points that I want to outline, we'll just jump right on over to that. I do want to mention that this presentation and the others that we've been recording and held here in this room over the past, I guess it's been a year already, over a year, maybe close to a year and a half. We have these presentations all archived at our YouTube channel. So if you've never been over to our IBFX YouTube channel, let me take you over there real quick and also give you the URL so you can head on when you have time. So let's jump on over to that screen. All right, and you'll see that this is our Interbank FX Videos YouTube channel, and that URL is www.youtube.com/Interbank FX Videos. It's plural, so videos. And we have, I don't even know how many videos we have, but we have a lot of them. And let's see. I'm not sure if it has the number of videos, but if you take a look, you'll notice that there's an all link where you can take a look at all the different, 185. Wow, okay. We got a lot of them. All right, so we've got everything from the recent webinars here that I've held. We've got different webinars and presentations from a number of speakers from Interbank FX, so by all means feel free to take advantage of that resource. Another resource I want to mention is our Daily Trading Edge website. It's relatively new, but it is an extension, a kind of a evolution, if you will, from our Daily Trading Edge updates that we used to have at IBFX.com. And what we've done now is we've moved it over to its very own website, dailyforextradingedge.com. And here you're going to find a number of updates each and every day. I write anywhere from 1 to 2 a day. The Daily Trading Edge drop-down menu will bring you to kind of a commentary of not only what I'm seeing as far as particular trades, but also some of my opinions about what's happening from a fundamental standpoint and how that's affecting price action. So it's kind of a, I don't want to call it an editorial, but it is very much my opinion of what I'm seeing and some of the fundamentals. I talked about the Euro-US dollar. I talked today specifically about the 4,500 level and how I feel that's going to impact price action. We'll talk about that tonight. So that's going to be a little bit of a combination of fundamentals, my trades, technicals, the market analysis is pretty much straight fundamentals and price action. Okay? So they're very similar, I guess, in some ways. And I will admittedly say that we're still kind of finding our particular voice. You know, there's a lot of sites out there that will show you and talk to you about generic market analysis. We don't like to be backwards looking. At least I don't like to be backwards looking. I like to talk to you about levels that I feel are either in play right now or will be, and what I'm going to be doing there, so that you can look ahead and plan ahead and see what's going to happen. I think it's much more difficult to forecast. And, you know, that's the point of trading, isn't it? We're all looking at the charts, analyzing fundamentals, looking at economic data, understanding price action, so we have an idea of what we would like to do next. And that's what I try to give you a look at through the Daily Forex Trading Edge. We're going to also have more education available right from the website. And you can see here we've just added an education tab. You can download kind of the greatest hits of the Daily Trading Edge. Also, it's a PDF. On top of that, we have a number of the webinars that both myself and Brian Kahn are conducting here in the room. And that's all right there at the Daily Forex Trading Edge. Last link I want to share with you is the ibfx.com/tools/grab link, because this is where you can download the plugin for the color coding of the candles, the 34 EMA wave, so the grab candles and the wave that you'll see running on my charts. I want to make sure you can get access to the charts the tools that I'm using on my charts, and this is where you'll get the grab. Okay, again, ibfx.com/tools/grab, G-R-A-B, which stands for green, red, and blue. All right, so let's get to our discussion here today. So as I mentioned, our talk is handling market transitions. And what's interesting about the timing of this discussion is the fact that I think we're looking at a number of transitions across multiple pairs. And I'm going to talk about why it's so important to recognize these and the kind of psychology that it reflects. So let's start off first with why it's so important to recognize transition. And I think squarely that is a conversation that obviously will involve understanding the market trend or phases, okay? And I know that many of you that have joined me here in the chat room or read any of the Daily Trading Edge and the dailyforextradingedge.com website know that, you know, at the heart of everything I do is this idea of market trends or phases, and how I use the 34 EMA wave to identify them. Well, one thing that occurs, and it's occurring right now, is what happens when an established trend begins to lose the sentiment and the momentum and begins to flatten out either the 12 to 2 o'clock uptrend or the 4 to 6 o'clock downtrend that we see. Now this can happen, of course, across multiple time frames. But the one that's probably most important to observe is the daily time frame, because it establishes what I call the directional bias. And that directional bias is essentially what I feel is the overall psychology of that pair. Realize that if you have an overall psychology that is bullish, think about what that means. We're typically going to push to higher highs. We're going to have higher lows. And there'll be a lot of attention paid to support because a lot of traders will be willing to do what? Buy into corrections lower. Okay? When the overall psychology is bearish, when that daily time frame is 4 to 6, we're talking about lower lows. Lower highs. And traders keying in on resistance. I feel that in an overall bearish tone, in an overall bearish trend, traders will be more likely to sell into corrections higher. So in other words, we're talking about pullbacks on the bullish side. We're talking about bounces on the bearish side, and pullbacks will be supported, and bounces will be sold into, or resisted, if you will. Will be resistance levels that traders will be willing to sell into when the market tone is bearish, when that overall directional bias is bearish. It's my opinion also. I don't want to use the word easy, okay? But easy comparatively, I feel that when there is a daily trend, in other words, when we have an uptrend or downtrend on the daily, it's, again, I hate this word easier, but I think it's easier to trade. I think when there is a clear psychology on that daily, the daily being the most psychologically relevant time frame, I do think it's easier to trade. Because, again, going back to higher highs, higher lows, the support, the tendency for traders to look at support and want to position themselves there in an uptrend, the tendency for traders to want to position themselves at resistance, that tendency is there. It's easier to recognize potential action, responses in a trend. Okay? It's just it's been my experience. All right? Because there is, why? And the reason for this is because of the dominant psychology. All right? Non-trending means no dominant psychology. This is where things get more difficult. And that's where our topic of handling transitions, I think, comes into focus. What do you do when the market's not trending? It's difficult. It's often very difficult to determine what to do. The reason being, again, is there is no dominant psychology. There's no overall bullishness, no overall bearishness, which means the way prices will respond to pullbacks and bounces is very different. Now there's two types of non-trending markets. If you go back to kind of the Charles Dow theory type description, there's distribution and there's accumulation. Now we can also call accumulation consolidation. We can also call it distribution congestion. You can even furthermore describe the price action behavior, the characteristics. Okay? Now, accumulation will tend to be less volatile. The support and resistance will be easier to recognize. There'll usually be less variance between the highs and lows of the channel. A channel to me implies a certain amount of organization, okay? While a range to me insinuates more variance between the highs and lows, a little less organization. The volatility is really what the big difference is as far as I'm concerned. That's really where the difference is. Because when it's volatile, it's less predictable. Prices will not necessarily respect near-term highs and lows in a way that prices will exhaust at that level or make some sort of acceleration or stall or reversal at that level. It's less predictable. Distribution is certainly less predictable. Okay? But it's that volatility that really makes the difference. So it's our job to determine which one are we dealing with. Okay? The way we do that, of course, is we use the 34 EMA wave. So, of course, we must start with that look back, or market memory as I call it. And we take our clock angle reading. All right? Accumulation or consolidation or that narrow sideways channel is going to have that 3 o'clock angle, while the distribution congestion, the volatile range sideways, is going to have what I call a 2 to 4 o'clock angle. I will tell you that the distribution market phase is easier to recognize or identify for what it's not rather than what it is. And what I mean by that is 12 to 2, 4 to 6, and 3 I think are fairly straightforward to identify. Okay, sometimes that 2 to 4 o'clock angle can look like any one of those briefly. In those times that you can't concretely identify that the market is moving up at 12 to 2, down at 4 to 6, or is flat and sideways enough to be at 3 o'clock, what you're left with by process of elimination is going to be the distribution, congestion, volatile range. Distribution or congestion is also that transitional market psychology that we have to be aware of. It also is that transitional market. And that means that when we're in distribution, we're volatile enough where the psychology really is difficult to pinpoint. So when the market isn't showing you a flat, smooth 3 o'clock 34 EMA wave, yet it's not steep enough to be trending, you're likely dealing with distribution, congestion, and that transitional market. The market isn't quite sure what it thinks about price action or news or data that just came out. Overall, there could be a lot of confusion. Case in point, let's jump on over to our charts here. And we'll talk about the Euro-US dollar. Okay? Now, what you're looking at is the quad view. I just call it a quad view because it's 4 charts. These 4 charts give me a look at a number of tools that I like to use. The MACD traditional, or the oscillator of the moving average, which is a signal line based MACD histogram. A quite slow setting on the stochastics of a 21-3-1. I also like to have just a chart of the wave and grab with a 20-period simple, sometimes even a 200-period simple moving average. I also like having a chart of the CCI that includes a CCI, a 20-period CCI. And then the final chart on the lower right-hand side is one that has the automated chart patterns, or the PRS, pattern recognition. And these 4 charts basically comprise all the different views that I like to see when I'm making decisions about the market. Okay, price-based decisions. Now, in terms of handling market transitions and what I like to do in terms of making that initial determination about that overall psychology, we're going to begin with the daily time frame. I'm really not interested in anything other than the wave and my grab candles, and making sure I'm looking at the chart within its 1-year market memory for the daily, so 12 months or 52 weeks. All right, that's where I want to start. If it's a little bit less or a little bit more, that's fine. You know, obviously we don't always necessarily have the luxury of the horizontal axis giving us exactly a year. Okay, if you want to err on the side of a little bit more, that's fine. But for example, this view going back to mid-July should suffice. It's a few weeks short, a handful of weeks short, but as long as you're aware of the 1-year high and low, that is fine with me. This view will give you everything you need to know. That 1-year view of the daily in terms of determining the overall psychology, or what I call the directional bias. It's always taken from the daily. So when we first have transitions, I'm not really interested in intraday transitions foremost. What I first want to determine is the overall psychology. And when we look at that, right now, as we mentioned, we're using the example of the euro-US dollar. And I'll go through the majors right now. What you want to do is find out, is there an overall psychology that seems to be dominating? And in this case, past tense, right? Looking back, if I look at simply colors, if I look at just the colors on this chart, would you all agree that for the most part, we're talking about a dominance of green grab candles? And for the most part, if I were to look at the 34 EMA wave and say, well, what's it been doing mostly for the past year? I'd say it's been moving up higher at an angle of 12 to 2. So green grab candles dominate this view, just from a color standpoint. And the angle of the 3 moving averages, so 34 EMA wave, we're dominated by what has been a 12 to 2 o'clock angle. So even though we've started to pull back a little bit and chop around a bit, the psychology that has dominated for the past year is one of a bullish psychology. The grab candles give me an idea, the green grab candles give me an idea of sentiment and momentum. And again, that sentiment and momentum has overwhelmingly been bullish. And because of that, we've seen for the most part the push for higher highs, support at the lower low, or support at the higher lows, and the uptrend, which is basically made up of the bullish sentiment, creating bullish momentum, and then of course we get that 12 to 2 o'clock, 34 EMA wave angle. Now, focusing on the hard right edge for the most part, you notice that recently we've actually had a little bit more confusion. And it's easy to identify confusion with grab candles, because what you'll see is when you look at a section of the chart, even though we've been seeing a lot of green grab candles most recently, before that we were preceded by some blue neutral candles, some red bearish candles. And we can see that the market has been switching its sentiment and momentum a little bit more frequently than had we seen between December and mid-April. Okay, even between the bearish sentiment of early November to late December. Okay, for the most part, that was dominated by red grab candles. Okay, so whenever you see the blue, green, and red coming fairly quickly in terms of their proximity to one another, that starts to indicate a little bit of confusion, a battling of opinions. When you have a lot of opinions in a very small amount of chart space, what that reflects is usually going to be exhaustion. It's going to be a situation where you're going to deal with a lack of follow-through because there is not a dominant psychology. Okay? And when you see the change, the rapid change between blue, green, and red, ask yourself, where's the confusion stemming from? And usually what you're going to find, starting with price, is that the fundamentals have shifted. Now, I'm not going to tell you that you necessarily have to go and become an expert in the fundamentals of any particular pair, but when you see price action like this, and then you go read even the most basic news feed, I think when you start with an understanding of price action and then go to news, you can put it in a different set of, completely different focus, a completely different perspective. For example, what's happening right now in the euro-US dollar? Think of the news headlines. These are just headlines you can read. You don't even have to read all the details of what's being done and how the bond rollovers are being battled out. I mean, you don't need to know the nuances. Just read some headlines. What's happening right now? German Chancellor Merkel, Angela Merkel, has really been cheerleading and been very optimistic about the future of the euro. Obviously, when you think of the stronger economies in the Eurozone, you think about France, you think about Germany. So when the German Chancellor starts talking about how optimistic she is about the euro, that they don't have a currency issue, they have a debt problem, and really she's been cheerleading the euro quite with good basis for some time. That optimism helped the euro stabilize and actually start moving up higher again. She's been very consistent about that message. Okay? What else has happened? Well, there's been, and anyone who looked at the price action today knows, there's been a lot of expectation and discounting. People have been baking into the cake a rate hike from the ECB, which Trichet actually Donkey Konged today, just slam dunked, just completely disappointed the market, okay, with his statements that were not nearly as hawkish as Euro bulls, Euro-US dollar bulls would have liked to have seen. Again, these are very broad-based assessments. These are assessments that I'm not getting, I hope you notice, I'm not getting very detailed into the fundamentals. You don't really need to, because what we're seeing is price action reflecting the psychology of the market. Okay? This transition is coming because there's a lot of different headlines that are pounding this pair right now, and more importantly, the pair is reacting to them. One of the things I see in terms of, I think, misguided use of fundamentals and where they often tend to get a bad rap is, remember, at any particular time, there could be a number of fundamentals swirling about any market. It's our job to look at price action, find out which one's being reacted to, which one's being discounted, and which ones are being dismissed. Okay? So a lot of the positive euro fundamentals, headlines, are being, for the most part, accepted and reacted to. Hence the green grab candles, hence the push that we've been seeing higher. Now today, let's zoom into today. We pulled back pretty hard today. Not enough on the daily chart to really make a huge dent in the move higher from the lows that we saw back on the 23rd and 24th of May. Okay? But in terms of the intraday view, it's a completely different story, isn't it? Let's go to the intraday view. So here's the daily view. Here's the 30-minute view. Take a look at that drop. In about 5 minutes, we really made the bulk of this move. And I talked about this on the Daily Trading Edge today. Okay? And I talked specifically about the 4,500 level. So if you haven't read that update, of course, I wrote it, so I'm biased, but please check it out. It'll give you a good idea of what I was looking at and why. Okay? So in terms of the price action intraday that we saw, what was this all about? Well, when Trichet Donkey Konged, as I say, the ECB rate hike expectations, and the June hike got pushed to potentially July, traders just, the way I looked at it, they threw a tantrum. They just literally threw a tantrum. They didn't get what they wanted now. They have to wait a month, and that was just unacceptable. And there, the euro just sold off. Now, I think the bigger picture here, and this is just my opinion at this point, in terms of dealing with this transition. Again, these are all just headlines that I like to read on a number of feeds. Okay, just headlines. I'm not getting deep into the economic discussion here. But I think one of the interesting things here is there was lower than expected, slower inflation. Now, the basis behind Trichet's argument for many, many months for hiking rates has been to combat inflation. Okay, that's a common theme you hear with any of the central banks that are thinking about hiking rates. But think about what else the Eurozone and the ECB has to consider. Is it just about inflation, or is there a little problem called sovereign debt and Greece that might be taking a little bit more of the spotlight? We can talk about inflation all we want, but think about the fact that with the sovereign debt, and there's been a lot of discussion about maybe private companies taking some of this debt. Germany and the ECB don't want to roll this debt over. Okay, but without getting bogged down in all that, wouldn't higher rates have a negative effect on dealing with this debt? If you owe money and someone hikes the rates on you, aren't you pretty upset? Forget all the highbrow discussion. Just in a very basic way, if you owe money or you're lending money out to combat a debt problem and you increase the cost of credit, you're kind of stepping on your own foot, aren't you? So what we have to, as traders right now, is ask ourselves, what's a bigger problem? Greece or inflation? And when the economic report comes out, when Trichet said inflation is slower than expected, and this Greece problem still isn't anywhere near settled. Okay, they got their money, but now we got to talk about paying the people back, right? The bonds. Do you think that the Trichet might come around in July and say, you know what, inflation wasn't as bad as we thought, and I've been telling you that the reason I've been wanting to hike rates has been inflation. Since it's not a problem and Greece is, sovereign debt is, I'm going to put it off another month. You think that may not be running across some traders' mind? And this is a very basic look at some fundamentals. Okay? I think sometimes people get a little too sophisticated with their fundamental analysis. We started with price action. We noticed there was some confusion on the daily chart. We noticed there was a sell-off on the intraday time frame. We looked to see what the headlines were. Since we know intraday there was a sell-off, what was the bearish headline? And the bearish headline was no rate hike, not in June, maybe in July, and slower inflation. You put all those pieces in place, and it starts to paint a picture. Starts to put together a puzzle, if you will. And that picture is we may not get rate hikes in July either. And I think that's where a lot of traders started putting the pieces for themselves together. Okay? So that's when I went ahead and looked at if there was a psychological level that was in play and how traders might be reacting at that psychological level to reflect. It doesn't matter what I think, right? When it comes to trading, I'm trying to measure the overall gauge, the overall psychology of the market. So somewhere I have to draw a line, and drawing lines at 00, major psychological levels, is very powerful. And the way I looked at it is, if traders believe that he could be a little bit more hawkish or even raise rates in July, my feeling was they would support 4,500. On the flip side, if traders weren't believing a word he was saying, that inflation is not the big problem, higher rates will make the grease problem bigger, more difficult to handle, especially for private companies who might want to take loans to assume some of that debt risk. All the more reason not to hike rates, in which case I think prices would dip below 4,500. I don't think traders have made up their mind yet, and it may not be something they'll even make up their mind about this week. But I think the battle will continue to rage until we get a clear idea, until a message is more clear. What is the bigger problem, inflation or grease? Because they are on two opposite sides of this rate hike discussion. So that makes sense to everybody. Now, when it comes to handling the market transition, do I have a clear trend here? Well, obviously with the green grab candles, we have certainly more bullish momentum than we do bearish momentum, more bullish sentiment than bearish sentiment overall. That does tend to support the argument for buyers to step in at 4,500. Okay, but until that wave gets to a more established 12 to 2 o'clock angle, there is a higher degree of difficulty for the continued climb higher, and there is more expectation, as far as I'm concerned, for exhaustion. Okay, so higher highs aren't necessarily, I think, in the cards here. Buying support, yes, on pullbacks, but the higher highs, I think, could be a question. When you have an unclear daily time frame, I'm not saying that you stop trading that pair altogether. In fact, what I then recommend to do is go to shorter time frames, because the sentiment can shift suddenly. The shorter time frames can adapt to those shifts better. You are not kind of married to the trade for a longer period of time, because if you are in a longer term time frame setup, daily, 240, even a 60, you need what? You need price organization, you need organization of sentiment and trend and momentum to get you to where you want to go usually. And if the market is confused, will they move in one direction with organization for very long? My experience has been no, they won't. So for that reason, I'm going to stick to shorter term time frames that don't require that longer term price organization, that don't require that longer term organization of sentiment and momentum and trend. I'll stay nimble, I'll stay short term. And it all stems from that lack of an overall trend on the daily. Let's take a look at another pair. And if you have any questions, let me know. Okay? Be happy to address them. We'll take a look at the cable here in a moment. Sharon had a question with the cable. Let me also address some of the questions that have popped up here, and we'll jump on over to the Swissy. After I take a look at the Swissy, Sharon will take a look at the cable. Got a question from Adi who asks, is the quad view a standard option in MT4? The quad view is just 4 charts that I have put my preferred indicators on, and then at that point simply done a horizontal tile to get that view. It's not a standard view. It's just something that you can very easily just do up on your own. That view was a popular one, and one of the ones that I use quite frequently, because there was a time that, for the most part, a lot of traders had one screen, one, say, 17 or 20-inch screen. Back when I was trading, 15 years ago, if you had a flat screen, I don't even know that we were available that long ago, maybe 10 years ago. I knew it was a big deal when I had 4 15-inch flat screens. That was a huge deal. Now I don't even know that you can get them that small. But from the perspective of real estate, your monitor real estate, the quad view was a really good setup. You could put 4 charts on one screen. Now I actually operate from 4 much larger monitors turned on their side. So I actually look at the world, and I think the way the internet actually is built, which is a vertical or portrait view, not a landscape view. It's interesting that monitors keep getting wider and wider, yet the internet is a vertical space. And so I've got my monitors turned on their side. That's what I think is the better view, and that's the way I've been looking at it for years. But the quad view still works, because what I end up with is 2 quad views, one on top of the other, for about 8 charts per screen. I know that might sound like a lot, but when you have color-coded candles, when you have a very clear idea of what you're looking at, your eyes can find what they need very quickly. But you might have to gradually get to that point. But I think looking at multiple charts simultaneously, and even multiple time frames simultaneously, offers a huge analytical advantage, a huge decision-making advantage when you're trying to make intelligent, educated decisions as quickly as possible. Looking at everything all at once makes that comparative process, I think, much faster and much clearer. Okay? So you can design your own quad view. It's not something that's standard in the platform, but it's easy enough to create. All right, Brad had a comment, which was, let's see here. Brad says, I accidentally deleted just the red candles the other evening looking at the same chart. Made the green look that much more powerful. Sort of an interesting, inadvertent observation. Okay, absolutely. I'm not sure how many of you are using grab candles, and I hope many of you are, or have at least tried them. And if you have, it still respects the benefit and the analysis of a traditional Japanese candle. But with all due respect to the candles, I think it's kind of a better Japanese candle, because it tells a little bit more of a story based upon, of course, the tools that I use, right? If someone doesn't understand the use of the wave and so forth, then yeah, it probably doesn't have the value. But once you understand the value of the wave and understand the formula of a trend, sentiment plus momentum equals trend, and understand that if you have a consecutive 3 to 5 green grab candles in succession, you might be looking eventually at an uptrend, or maybe it's 5 to 7 candles. Then you can start looking at the waves angle and so forth. I think you start putting the pieces together and you get a better idea of what the basis of my trading decisions are, which is that market trend or phase. So that's why I gave that link to the grab download early on, because I hope you guys at least will check it out and see what you think. All right, so as far as, let's see, Mingying has a question. How are you doing, Mingying? Question here is, so am I expecting that the price will sink deeper into the 34 EMA high on the daily Euro-US dollar? My suspicion is that where we are right now is probably less about the wave, although I do believe we hit the 34 EMA high on the sell-off today. It's less about the wave right now and more about 4,500. And if you read the update that I posted at Daily Forex Trading Edge regarding where and why I'm the analysis was called Where and Why I'm Willing to Buy into this Euro-US Dollar Sell-Off. Here's the link. You'll see how I believe 4,500 is really where I'm keying in on what the pair will do next. Okay? The wave angle is not established quite yet enough that I'm going to put a lot of stock into it, but it is more of a 12 to 2 o'clock angle, and we've already seen respect for the 34 EMA high. So again, for now, yeah, I'll respect that 34 period EMA high, which is sitting at 44.66 right now, but I think the real story, the real battle is occurring at the major psych level, the 4,500 level. So thanks as always for your question. The quad view, yes, is just 4 charts. That is correct. Follow up to Adi's question. It's just 4 charts, and I put one of my preferred indicators on each. That's all that the quad view is. Just 4 of my 4 charts with the tools that I like to look at. Another way you could do quad is, look at the 1530, 6240 simultaneously. So when you're doing your triage, looking for where the market psychology is the clearest, or the 34 EMA wave clarity, you can make that decision fairly quickly by looking at 4 different time frames at the same time and try to determine where the trend or not trending market is showing the clearest clock angle reading of the 34 EMA wave. Okay. As far as the grab tool, if it's not working properly, I do believe you have to be on the Interbank FX Trader 4 platform. I don't know that it works on all versions. Okay. The other thing that you might want to do if it's not color coding your candles, and I've gotten this question quite a bit, is head on over to Properties. Okay. Click on the Common tab and make sure that the chart on the foreground option here in the upper left-hand corner is not checked. Okay? Because if you check it, what happens, or if it is checked, what happens is you lose the color coding. It defaults back to the color that you specified on the Colors tab. So to override that, you uncheck that, and it'll go to the grab color coding. Okay? All right. So let's talk about a market that is not in transition right now, which is very clear in its directional bias. That is the dollar Swissy right now. The dollar Swissy, because of the franc strength, because the franc's status right now is at flight to safety, safe haven currency, that's where the flows are going right now into the franc, and it continues to strengthen against everything, especially that dollar. Here we have a better idea of the fact that if prices rally, there's a better chance that traders are going to be very willing to sell into it. The directional bias here is clearly down. The color that dominates by far over the market memory, the past year of this pair, has clearly been red. So traders are much more comfortable positioning themselves at resistance. They're much more comfortable selling into strength because there is a clear directional bias. And I think trading the Swissy has been fairly straightforward once you find a short entry that triggers, even intraday. Okay? Today you'll see a lot of bullishness on the short-term time frames like the 15 or 30, okay, because of the bounce as the dollar gained a little bit today. Got some footing over 74 on the dollar index. But when you step out to the 240 or the daily, I think a lot of traders are going to be looking for opportunities to sell into that ceiling. Don't simply sell into strength because of the directional bias, but let the directional bias help you choose your strategy. Don't look for counter directional bias or counter trend trades on longer term time frames. You're fighting the dominant psychology. If you do want to get long the Swissy, do so on a short-term chart. If you want to get short the Swissy, do so in any time frame. Okay? But because there is a clear directional bias, it will, for me, eliminate the likelihood, eliminate the possibility of my considering long entries on the 240 for sure, and even possibly the 60. Okay? So that's the way I'll basically use that directional bias to help me determine which time frames to consider and which direction to trade in, depending upon the time frame. But what happens when you have the lack of directional bias? Well, the lack of directional bias will either do one or two things. You can determine to not trade the pair at all. Let's jump on over to the cable right now. You might decide by looking at the daily cable that there is no dominant psychology, that the psychological state of that daily chart is just a mess, which I agree that it is. And just to steer away from that chart or focus on short-term time frames like the 5, 15, or 30. Okay? Now, for those of you that are having questions about how to set up 4 windows or how to set up the charts, my recommendation is please give customer service a call. They'll walk you through it step by step, and that way you can have your platform set up however it is that you need it to be set up. Okay, if you wouldn't mind, for those of you that have questions about the platform setup itself. So comparing the psychology of the daily euro US dollar to the daily Swissy to the daily cable, you can see the daily cable is probably in the most unclear price action right now. It's in price action. It's narrow ranging. Okay? There is no dominant psychology, even though we have a little bit more green in terms of the grab candles. You'll see a lot of blue neutral candles mixed up in there as well. Okay? And then on top of that, we're definitely in congestion or distribution in terms of the likelihood for exhaustion at recent highs and lows, but it becomes extremely unpredictable. My advice then is go short term. Don't make your trade rely on longer term price action organization to get your follow through. You're not going to get it. Traders are not that certain that they want to run this market in any direction. So you definitely don't want a longer term time frame requiring longer term organization to get you to where you want to go, which is ultimately your profit target. Okay? Stay short term. And for me, I define short term as 5, 15, 30. 60 is kind of iffy. 240 is definitely long term. And of course, as is daily. All right, got a question here regarding the Swissy. Let's see. Did I take a stop loss for the recent dollar Swissy daily swing short entry in May? You know, I'd rather not go back to older trades and so forth and stick to our conversation, but let me go back and I'll walk you through that. Okay, so there were a number of setups, you know, short setups that we had talked about in the Swissy. You know, I've probably taken dozens of trades since then. To sort of specify out a single one is difficult for me. Okay, but with that in mind, I'm fairly sure that this is the price action that you're referring to. Is when we had this correction here. Back when we had this correction, the market was heading down in more of that 4 to 6 o'clock angle. And then what happened Okay, what happened is, and what I'm doing, I'm just kind of sliding the price action to the end of the hard right edge of the chart. What happened is prices then popped up over the top line of the wave. Okay, you see that there? And we also started to flatten out on the wave, which we transitioned, again, transitional market. We transitioned out of that downtrend and got a little choppy. Now, simultaneously, while there's a short setup on the daily, part of what I'll talk about every now and then is before you get into any kind of short setup, and I do believe what I ended up doing, if I recall, I'm just kind of flipping through my notes here. I believe what I ended up doing is taking, I do believe I was stopped out on that. Now, while I had some daily shorts, I know I was also long intraday. There were some long swings intraday. But I do believe I was stopped out of that. I don't recall precisely on this entry, but I'm fairly certain I was stopped out of it at some point. And I think, if I remember right, I had another short setup that triggered later on. And you can see what the pair has done since. So I do believe I was. You know, most of the time, if I see price action poke up through the opposite side of the wave, unless there was a key level nearby, for the most part, there's a good chance I got stopped out. On the flip side of that, if I remember also, there was and I saw you mention it there, a 50-period SMA. And on my E-signal charts, prices actually did not pop out the other side of my 34 EMA wave. So I'm trying to remember which one. I know I got stopped out of some sort of position back there in early May. I just don't recall, to be quite frank, which one it was. You know, it's a month ago, and like I said, I've made dozens of trades since. So I probably couldn't tell you with absolute certainty. But I knew there was a trade that I did get stopped out of for a pretty good hit. And that one might have been it, but I don't recall 100%. But, you know, you bring up a good point with the 50-period SMA. I don't necessarily want to give traders a reason to hang on to a trade based upon a 50 or based upon another reasoning other than the validity of the wave, because what happens is they'll keep looking for another reason to hang on to the trade. Now, while the 50, 20, 20, 50, and 200 are very strong psychological simple moving averages that we've talked about quite often here in the chat room, my only hesitation is if you are going to use those moving averages, make sure that past price action has respected that level as a resistance level, in this case because of the downtrend. And you know, you really need to have excellent discipline because it's so easy to keep talking yourself into another level to consider. I know that we started getting very close to the 9,000 level, and it just can turn into a slippery slope. So that's my caution there. The 50 period, though, was in play. Yes, I do recall that. The 50 period was in play. So I think more advanced traders could have used that as an alternative to the 34 EMA high, especially when the wave lost its 4 to 6 o'clock angle. Okay. Again, for the most part, I would just assume you use the 34 EMA wave. The difficulty here was on my E signal, it was not penetrated. Here on my MT4, it was, and it does get very difficult when you're using different indicators based upon slightly different price action. It does get difficult. I will not deny that. One of the challenges of off-exchange trading, for sure. Okay, but the 50-period simple was an interesting, I'm glad you mentioned that. It was an interesting level to consider, but I would only recommend that for advanced traders, okay, that have the discipline, for sure. Let me show you that 50-period real quick here since we were talking about that. There you go. That's the 50. I just added there, and you'll see it pop up just, see, there's that 50. And it did, and you notice back here, it acted as resistance. And of course it did again. But it's very difficult, you know. It's easy for me to say in hindsight, yeah, go ahead and use the 50, but I'll tell you 90% of the time, unless there's some sort of psychological level or significant downtrend or uptrend line to consider, that wave is going to be what gets me out of the trade. And I don't mind taking the hit because, for the most part, I might be long intraday, and that would have taken away some of the pain of taking that stop loss. Because the overall directional bias has been down, I've been short this market many, many times since. So that loss was just a fraction of the gains that I've had following the overall trend. So, just food for thought. Thank you for that question. All right, where would be a good place to sell the dollar Swissy? Right now, I don't have a setup that I'm watching that has any kind of proximity. In other words, I don't have a near-term setup. But if and when I do, you can count on it being posted up at the Daily Forex Trading Edge or on my Twitter account, both of which you can follow free of charge. So I don't have one that's near-term right now. When I use the word proximity, by the way, sure, I could say if we rally up to 85.80, which is about 170 pips from where we are right now, there's a daily chart swing trade. But there's no proximity. I mean, we're not going to do that till maybe Tuesday or Wednesday of next week, if we even do. So there's no proximity. There's no near-term decision that needs to be made based upon that price level. It's a valid price level. Okay, but it's not one that I'm going to be reacting to anytime soon because of how far away it is. It lacks proximity. All right. What are my thoughts on the Asian session? Sharon, my thoughts on the Asian session basically are, as long as you trade them with the understanding that your pip movement ranges are going to be, for the most part, again, it varies with each pair, but for the most part, your pip movement ranges are going to be narrower than the U.S. overlap with Europe and the UK. As long as you recognize the difference in volatility, I think it's fine. I think one of the big mistakes a lot of traders make is they sit down to trade, say, between 8 p.m. and 11 p.m. Eastern Standard Time. They look at the price action that occurred between 8 a.m. and 11 a.m. Eastern Standard Time and assume that kind of volatility and price movement, and that's just not what the Asian markets typically yield. Now, obviously, you want to take a look at the economic calendar. Another great tool to use would be the AutoChartist price movement studies that you can get through your AutoChartist platform that's available to IBFX clients. You can absolutely look at that. Okay. All right, I'm going to wrap up our discussion here with one last question, and that is from Minying, who asks, so the better way to do it, and this is obviously going back to the earlier question regarding that swing short, so the better way to do it is get stopped out at the 34 EMA wave high and then enter again when there's another setup. I won't say the best, but Minying, the one that I would tell you will keep you out of trouble most would be, yes, doing that. Now, obviously, every situation is different. Your observation with the 50-period simple being past resistance and then therefore maybe a alternative consideration for a stop loss in the situation of this daily Swissy, certainly it's easy for me to say now, use the 50. I think that decision would have had to have been made at the time of the entry. But for the most part, I will tell you what you just said, most of the time will keep you out of larger trend shifts and hanging on to a trade for too long. So yes, that is my advice, unless there is a tremendously good reason to override that validity in the case of a 20, 50, or 200 period simple moving average, or the case of a very strong resistance level, or a psychological level, or a Fibonacci level that you feel could be close enough to the validity level to not, dramatically increase your risk. You don't want to dramatically increase your risk. So if it's within a realistic distance, okay, you don't want it to dramatically increase your risk and get you upside down on your, say, your 1-to-1 risk-reward ratio. You don't want your trade to be upside down on its risk-reward ratio. But if it is a reasonable amount of additional risk to take, and you feel that that level is a price level that has been reacted to before and could be reacted to again, in those situations, I think an override is fine. But for the most part, you're absolutely right. Just use that 34 EMA wave high in a downtrend or 34 EMA wave low in an uptrend to gauge your validity. Does that make sense? I hope it does. You know, the exceptions are difficult, and they have to be assessed as they occur. And if there's got to be a darn good reason too, right, to bend the rules. And it's definitely not a breaking of the rules, because you're still relying on resistance or support for your exit, but just make sure you're not looking for a reason to stay in the trade. Make sure it's not done from a denial type mentality. That's why I say it's a little bit more advanced, for sure. Okay, thank you very much, as always, for all your thoughtful questions. Even more so, thank you for your time. Thank you for letting me be your teacher, your coach here for this hour. I appreciate it very much. Hopefully this was beneficial and gave you a couple different ways to deal with the transitions that we're seeing in the market. It is difficult trading right now, my friends. It has been difficult. You know, compared to, say, the earlier part of this year when the downtrend in the dollar was crystal clear and the trends on the daily charts were crystal clear. Transitional markets are, by their very nature, due to their confusion and limited price range, more difficult to trade. And that's why it's so important that you recognize these transitions and adapt and react accordingly. All right, so we will not be having a session next week. I'll actually be on vacation. So everyone, enjoy your summer. We have plenty more sessions throughout these months coming. So again, thanks for your time as always. And I'll see you on, it will be, I believe, the 23rd. Our next session will be on the 23rd. Okay? So, again, hopefully I'll see you at the Daily Forex Trading Edge or Twitter or wherever it is that we communicate. And until then, heads up, watch the price action. I think we're going to be dealing with a fairly bumpy road for some time. Okay? There's definitely opportunity out there. Just be careful and stay nimble. Watch those short-term intraday time frames. Take care.